Technical indicators and oscillators. In this video, we will see various technical indicators and oscillators used in technical analysis of a stock. We will also see how traders use these indicators in their trading. However, please remember that each indicator has its strengths and weaknesses. A detailed study of the indicator is required before anyone incorporates it in their trading. This video is meant as an introductory video to the world of technical indicators. So let's begin. Indicators and oscillators. Indicators, as the name suggests, are derived using price and or volume to get an idea about market direction. Indicators can be broadly classified as follows. Oscillators oscillate between a bounded range, generally 0 to 100. Example are RSI, Stochastics, ADX. Non-bounded, as the name suggests, non-bounded indicators are not bounded within a range. Leading indicators, they are predictive, which are used to forecast price movement. They work best in range-bound markets. Examples are Stochastics, RSI. Lagging indicators, opposite to leading indicators, they are reactive and useful for confirmation of trend. Works best in trending markets. Examples are moving averages, MACD. Now we will look at some of the popular indicators one by one. Relative Strength Index, RSI. RSI is a momentum indicator. It is an oscillating indicator that oscillates between 0 to 100. It is considered overbought when it is above 70, and oversold when it is below 30. Two ways to trade with RSI are overbought or oversold, that is, if RSI indicates overbought, traders tend to sell the stock and vice versa. Divergence, that is when the price of a stock and the RSI move in opposite directions, traders tend to buy or sell depending on the type of divergence. Stochastic. Stochastic is a momentum indicator. It is an oscillating indicator that oscillates between 0 to 100. It includes a slow stochastic indicator, %K, and a fast stochastic indicator, %D, which is the moving average of %K. Ways to trade with stochastics. Overbought above 80% or oversold below 20%. Traders tend to sell when overbought and buy when oversold. Crossover, that is fast stochastic %D crossing the slow stochastic %K. A crossover indicates buy or sell indication. Divergence, that is when the price of a stock and the stochastics move in opposite directions, traders tend to buy or sell depending on the type of divergence. A combination of above. Moving averages. Moving average is a line plotted by taking the average of price over a specified period. A moving average smooths the price action and cuts the noise. Moving averages can be simple, SMA, or exponential, EMA. And EMA give more weightage to most recent prices in calculating the moving average. Ways to trade with moving averages. As support and resistance levels. Crossover between two different moving averages. A crossover is an indication of change in trend for buying or selling. Bollinger Bands. Bollinger Bands developed by John Bollinger in the 1980s. It comprises of two lines plotted 2 standard deviations away from a moving average of price, to form a band around the price. The bands create an envelope around the price. Ways to trade with Bollinger Bands are: indication of overbought if price is near upper band and oversold if price is near lower band. Indication of volatility, if bands squeeze together, it indicates periods of low volatility and vice versa. Breakout from the points, 90% of price movement is expected to happen within the bands. MACD. MACD or moving average convergence divergence is a trend following momentum indicator. It consists of a MACD line, a signal line, and histogram. It is calculated by subtracting a longer period moving average from a shorter period moving average. The signal line is calculated by taking a moving average of the MACD line. The histograms plots the distance between the MACD and its signal line. Ways to trade with MACD are: Crossover of MACD line and signal line as a buy or sell trigger. Divergence. ADX. ADX is used to indicate the strength of a trend. It consists of two directional movement indicator, DMI, lines, and one ADX indicator line, which is derived from the two DMI lines. ADX line does not indicate direction of the trend. A reading above 20 to 25 on ADX line is considered a trending market. Ways to trade with ADX. ADX indicator can be used to decide when to use trend following strategies. Supports and resistances. Support and resistances are important trading points. There are many different ways to calculate supports and resistances, such as 5 points pivots, Fibonacci, Camarilla, high volume nodes, decision points, etc. All these have their own rules of trading. Supports and resistances are predictive in nature and can be treated as a leading indicator. Ways to trade with supports and resistances are: use them as entry and exit points. Use them to decide day's trend. End of technical indicators. So in this video, we got introduced to a range of technical indicators and how they are used in trading by technical analysts. A lot of indicators give similar kind of information about the market. What is important is to determine what you want to know about the market, then choose 2 to 3 indicators which best suit your purpose. A deeper study of the chosen indicators will be required before you decide to incorporate them in your trading. As a starting point, you can start plotting these indicators on your charts, and check how they behave along with price. If you liked this video, don't forget to like and subscribe to our channel. If you want us to make a video on any other specific topic related to stock markets, please mention it in the comments box. Thank you for watching.